Something quietly changed in your Social Security check this April, and most people have no idea it already happened. The 2.5% COLA adjustment that went into effect in January 2026 sounds like a win on paper, but here's what nobody's telling you: Medicare. Part B premiums jumped too, and for millions of recipients, that increase is eating directly into that raise before the money ever lands in your account. April 2026. Payment dates have shifted because of how the calendar falls, and if your birthday lands between the 1st and 31st, your deposit day is not what you might expect. The SSA has also quietly updated its direct deposit processing windows, meaning some banks are showing funds a full day later than previous years. On top of that, there are new income threshold rules affecting taxation of benefits for seniors earning above certain limits, rules that took effect this year with zero fanfare. This video breaks all of it down: exact dates, real numbers, and what's actually hitting your account right now. Let's start with the payment dates, because this is the first thing that trips people up every single April, and honestly, it trips people up more than it should because the Social Security Administration does not make this simple. The way your payment date works has nothing to do with when you applied, how long you've been receiving benefits, or even how much you receive. It has everything to do with your birthday, specifically the day of the month you were born. That's it. That's the whole system. And once you understand it, April 2026 starts to make a lot more sense. If you were born between the 1st and the 10th of any month, your April 2026 payment landed on Wednesday, April 9th. If your birthday falls between the 11th and the 20th, your payment date was Wednesday, April 16th. And if you were born between the 21st and the 31st, your check arrived on Wednesday, April 23rd. Now, here's where people get confused. Some of you are receiving supplemental security income, which is SSI, and that payment schedule is completely different. SSI payments for April 2026 were issued on April 1st, which fell on a Wednesday. So if you're receiving both SSI and regular Social Security retirement or disability benefits, you're actually looking at two separate deposits hitting your account on two completely different dates in the same month. That's not a glitch. That's not an error. That is exactly how it's supposed to work, and knowing that saves you a panicked phone call to your bank or to the SSA. Now, let's talk about what actually happened to the dollar amount in your check, because this is where most people have real questions and real frustrations. The 2.5% cost of living adjustment, which everyone calls the COLA, went into effect starting with January 2026 payments. So by the time April rolled around, that adjustment has been in your check for 4 months already. But here's what's important to understand. A 2.5% increase sounds generous until you do the actual math on what the average benefit looks like. The average Social Security retirement benefit at the start of 2026 sits around $1,976 per month. A 2.5% increase on that figure adds roughly $49 a month. That's your raise. $49. Now, nobody's going to turn down $49, but let's be honest about what that actually covers in today's economy. Groceries have not gotten cheaper. Utility bills have not dropped. Prescription costs are still climbing for a large number of seniors across the country. So yes, the COLA happened. Yes, you received it. But whether it actually kept pace with your real-world expenses is a completely different and much more important conversation. And that brings us to Medicare Part B, which is the piece of this puzzle that almost nobody talks about until it's already hit their account. Medicare Part B premiums for 2026 increased to $185 per month, up from $174.70 in 2025. That's an increase of $10.30 per month. Now, here's why that matters so much in the context of your Social Security payment. If you're enrolled in Medicare and receiving Social Security, your Part B premium is automatically deducted from your Social Security check before it ever reaches your bank account. So that $49 average increase from COLA gets reduced immediately by the $10.30 Medicare Part B increase. You're left with a net gain of roughly $38 to $39 per month in real money actually hitting your account. And for people at the lower end of the benefit scale, that number shrinks even further. Some recipients who receive smaller monthly benefits saw their COLA gains almost entirely wiped out by the Medicare premium increase. That is not speculation. That is straightforward arithmetic, and it's something you absolutely deserve to understand clearly. Now, let's get into something that a lot of financial content about Social Security completely glosses over, and that is the taxation of your benefits. A lot of people assume that Social Security income is tax free, and that assumption costs them real money every single year. Here's how it actually works. The IRS uses something called your combined income to determine how much of your Social Security benefit is subject to federal income tax. Your combined income is calculated by taking your adjusted gross income, adding any non taxable interest you earned, and then adding half of your total Social Security benefits for the year. If that combined income number comes in between $25,000 and $34,000 for a single filer, up to 50% of your Social Security benefits can be taxable. If your combined income exceeds $34,000 as a single filer, up to 85% of your benefits can be subject to federal income tax. For married couples filing jointly, those thresholds are $32,000 to $44,000 for the 50% tier and above $44,000 for the 85% tier. Here's the truly frustrating part. Those income thresholds were set back in the 1980s and have never been adjusted for inflation. Never, not once. So, as Social Security benefits have slowly risen over the decades through annual COLA increases, more and more seniors have been quietly pushed into taxable territory without Congress ever officially raising a tax rate. It just happens automatically because your benefit grows, but the threshold stays frozen in 1983. This is not a small issue. The Social Security Administration itself has acknowledged that a growing percentage of recipients are now subject to benefit taxation compared to when the rule was originally designed. If you are not factoring this into your annual tax planning, you may be sitting on an unexpected tax bill at the end of the year, and April is actually a great time to think about this because you've just filed for 2025 and you can start adjusting your withholding or your estimated payments for 2026 right now before it gets away from you. Let's shift to something that affects a specific group of people in a very significant way, and that is the windfall elimination provision and the government pension offset. Now, if those terms are unfamiliar to you, stay with me for just a moment because this could directly affect your household. The windfall elimination provision, known as the WEP, reduced Social Security benefits for workers who spent part of their career in jobs that did not pay into Social Security. Things like certain state and local government positions, some federal jobs under older retirement systems, and certain foreign employment situations. The government pension offset, the GPO, similarly reduced spousal and survivor benefits for people receiving government pensions from non covered employment. These two provisions affected roughly 3 million Americans, and they were the source of enormous frustration for decades because many people felt they had been unfairly penalized for public service careers. Here is some genuinely good news that deserves real attention. The Social Security Fairness Act was signed into law in January 2025, and it fully repealed both the WEP and the GPO. For people affected by those provisions, this is not a small change. This is potentially hundreds of dollars per month in additional benefits that they are now entitled to receive. The Social Security Administration has been working through 2025 and into 2026 to process these changes, issue retroactive payments owed from the date of repeal, and update monthly benefit amounts going forward. If you or someone in your family was affected by the WEP or the GPO, and you have not yet contacted the Social Security Administration to verify your updated benefit amount, that needs to happen as soon as possible because there is money that may be owed to you, and the SSA is not going to automatically find everyone who qualifies without some level of follow through on your part. Now, let's talk about what's happening with Social Security's full retirement age, because this affects everyone who has not yet claimed benefits and is still making decisions about when to file. The full retirement age, which is the age at which you can claim 100% of your earned Social Security benefit, is currently 67 for anyone born in 1960 or later. That's been phased in gradually over many years, and it is now fully in effect. If you claim before full retirement age, your benefit is permanently reduced. If you claim at 62, which is the earliest possible age, your benefit is reduced by as much as 30% compared to what you would have received at 67. On the other end, if you delay claiming past full retirement age, your benefit grows by 8% for every year you wait, all the way up until age 70. After 70, there is no additional increase for waiting, so there is no financial reason to delay beyond your 70th birthday. The decision about when to claim is one of the most consequential financial decisions a senior can make, and it is deeply personal because it depends on your health, your other income sources, your spouse's situation, and your own projection of your longevity. But what's important to understand in April 2026 is that the landscape around this decision has been shifting. With inflation still affecting household budgets and investment portfolios, having gone through volatility in recent years, more people are feeling pressure to claim earlier than they originally planned. Financial pressure is real and it is valid. But if you claim early purely out of short term financial anxiety and you end up living into your 80s or 90s, that early claiming decision can cost you tens of thousands of dollars in lifetime benefits compared to waiting even a few additional years. This is not meant to pressure anyone. It's meant to make sure you're making this decision with complete information rather than just reacting to the moment. Something else worth discussing is what's been happening with Social Security's direct deposit processing, because a number of recipients have noticed timing differences in 2026 compared to prior years. The SSA processes payments through the Federal Reserve's ACH system, which is the same electronic transfer system your bank uses for most direct deposits. In past years, many recipients would see their funds available first thing in the morning on their scheduled payment day. In 2026, some financial institutions have been showing a processing window that pushes fund availability to later in the morning or, in some cases, to afternoon hours on payment day. This is not a missing payment. This is a bank-level processing timing issue, and it varies by institution. If your bank has changed its ACH processing schedule, there is very little the SSA can do about that on their end. The payment leaves the federal system on time. What your bank does with it after that is governed by your bank's own policies. If this is causing you problems, it's worth a direct conversation with your bank about when ACH credits are made available in your specific account type. Let's also address something that's been causing real confusion online and in senior communities, and that's the ongoing discussion about Social Security's long-term funding situation. You may have seen headlines saying that Social Security is going broke or that benefits will be cut by a certain percentage in the 2030s. Here is an honest and grounded explanation of what that actually means. The Social Security trust funds, which are the reserves that supplement payroll tax revenue to pay benefits, are projected to be depleted sometime in the mid-2030s if no legislative changes are made. The most recent projections from the Social Security trustees suggest this could happen around 2035. If depletion occurs with no changes made, the SSA would only be able to pay out what comes in from payroll taxes at that point, which is projected to cover roughly 83% of scheduled benefits. That is not a full collapse of Social Security, it is not zero, but it is a meaningful cut that would affect real people's real lives, and it is a legitimate reason for people approaching retirement to think carefully about not relying entirely on Social Security as their sole source of income. Congress has options available to address this before it becomes a crisis: raising the payroll tax cap, adjusting the COLA formula, gradually raising the full retirement age further, or finding some combination of revenue increases and benefit modifications are all tools on the table. What Congress will actually do and when they will do it is genuinely uncertain. What is not uncertain is that Social Security as a program is not disappearing. The political reality of eliminating a program that tens of millions of Americans depend on makes outright elimination essentially impossible. Reform is coming in some form. The question is what shape it takes and how much advance notice people will have to plan around it. What you should be doing right now in April 2026 is making sure your Social Security account on SSA.gov is active and up to date. Your My Social Security account online gives you access to your complete earnings history, your benefit estimates at various claiming ages, your payment history, and the ability to update your direct deposit information, your address, and your tax withholding preferences. If you have not set up this account, doing so is completely free and takes about 15 minutes. It is one of the most practical and protective steps you can take because having direct access to your own SSA records means you are not dependent on a paper statement or a phone call to know what's happening with your benefits at any given time. The bottom line of everything covered in this April 20 to 26 update is this: Social Security is not a static program that you set up once and forget about. It is a living, changing system that responds to legislation, to economic conditions, to Medicare policy, and to decisions made in Washington that directly affect the money landing in your account every single month. Staying informed is not optional if you want to protect your financial security. The details covered in this video are exactly the kind of real, ground level information that cuts through the noise and tells you what is actually happening versus what sounds alarming on a headline. Keep watching, keep asking questions, and make sure the people in your life who depend on these benefits are hearing this information too.